Hi guys, for today our topic will be the accounting cycle and the analyzing process. We start first with the accounting cycle. So what is the accounting cycle? The accounting cycle is a series of well-defined steps leading to the communication of the effects of a business transaction. So remember before we talk about the definition of accounting. So we have here different processes or steps, and ultimately we communicate information, primarily financial in nature, to different users. And what is the purpose again of that financial information? It will be used for economic decision making. So again, it presents steps or procedures that is used by the entities to analyze transactions, record it, and further communicate it to different users that will be useful for economic decision. So we have different steps in accounting cycle. So let's start now with the steps in accounting cycle. So the first step in the accounting cycle is identifying and analyzing. Okay, identifying and analyzing. So when we say identifying and analyzing, take note again, we said we only identify transactions pertaining to the business. So we look for business transactions. And that business transaction must be accountable, must be accountable. So when we say accountable, it must affect the assets, liabilities, or equity of the business. So why only business transaction? Because of the separate entity theory, that the owner and the business are separate. Hence, we will only record business transaction. Next, we talk about your accountable event. When we say the event is accountable, of course, it affects the business and it affects the asset, liability, or equity of the business. So if ever the transaction affects any of those three items, asset, liability, or equity, then we say it is accountable. We go now to the second step, which is journalizing. So under journalizing, we are to record the identified business transaction to the books, So I told you before, whenever you hear the word books, we talk about your journals. So books are your journals. Books are your journals. And journals is defined in accounting as the book of original entry. Book of original entry. So why is journal considered the book of original entry? It is the book of original entry because it is the first time that the transaction or event is captured in the books. So we already have your business transaction. We said it is an accountable event. What's the next step? You place it now to your journals, which is known as your book of original entry. Original because it is the first time that you will record the business transaction to the books. Now, when we talk about journals, there are two types of journals that can either be a general journal or it can also be a special journal. So what is a general journal and what is a special journal? We first go with special journal. Special journal used to record transactions of similar nature. So only similar transactions are recorded. similar transactions are recorded. So in special journal, we group the recording per transaction. Okay, so what are some examples of special journals? So examples of special journals. First, we have your cash disbursement journal. Okay, so sir, what is the use of our cash disbursement journal? Take note, in a special journal, we group similar transactions. So when we say cash disbursement journal, the similar transaction here is the cash disbursement. So any transaction which relates to the disbursement of cash is recorded here. So for example, purchase of supplies through cash. That is a cash disbursement. Payment of salaries. That is a cash disbursement. Purchase of property. That is a cash disbursement. Therefore, when we say cash disbursement journal, the main or similar transaction that is grouped under that special journal is cash disbursement. Therefore, if the transaction relates to a decrease in cash, cash disbursement, decrease in cash, or disbursement of cash, then you record it in the cash disbursement journal. Another example of a special journal is the cash receipts journal. Cash receipts journal. So what is the use of the cash receipts journal? The cash receipts journal is used to record any receipt of cash or any increase in cash. So for example, sales for cash. So you sold something for cash. Since you received cash, it is part of the cash receipts journal. Okay? Anything that will increase your cash. Collection of accounts receivable. So you collected some of your accounts. When you collected something, that is a cash receipts or cash receipt. Therefore, you place it under your cash receipts journal. So the similar transaction that is grouped under your cash receipts journal are your cash receipts. Another example of a special journal, we have your purchases journal. Purchases journal. So when we talk about purchases journal, we talk about credit purchases of merchandise. Credit purchases of merchandise. So purchases journal happens only in case you are in a merchandising company. So we record all your credit purchases. So instead of purchasing through cash of a merchandise to be resold to other people, you purchase merchandise on credit. And it is recorded under purchases journal. Another example of your special journal is your sales journal. Sales journal. So what about sales journal? It is your credit sales. So if ever you have credit sales, meaning instead of receiving cash for your sale, you sold it on credit. Pinautang mo yung benta mo. So we record it under your sales journal. Okay. So again, I have two types of journals, general journal and a special journal. If that is a special journal, we only record similar transactions. Okay, and examples are cash disbursement, cash receipts, purchases, and sales. Normally, we only use these special journals. And what about your general journal? What is the use of your general journal? Your general journal is a journal in which we use to record transactions other than those recorded in the special journal. So you record transactions in the general journal that is not recorded in the special journal. Okay, so if you did not make use of your special journal, then you can use the general journal, meaning if it's not cash disbursement, it is not cash receipt, it is not a purchase, it is not a sale, therefore, you place it on the general journal. Okay, take note, you can make use of the two journals, a special journal or general journal. However, sir, what if there's no special journal? Eddie, you record everything to the general journal. But what if, sir, there is a special journal? Then you can record to the special journal at the same time general journal. But the main requirement is there must always be a journal that can be your general journal. Hindi pwedeng panay special journal, kailangan may general journal. Pwedeng pure general journal, pero hindi rin naman pwedeng pure special journal. Okay? So again, where do we record the business transaction that was analyzed in step 1? It is recorded in the journals, the book of original entry. And when we talk about journals, that can either be general journal or a special journal. We go now to step number 3. So what is the step number 3? So again, our first step is we identify and analyze. Our second step is to record it in your journals or the journalizing process. We go now to the third step. The third step is posting to the ledger. Posting to the ledger. So when we say posting to the ledger, we transfer the data recorded in the journal to the ledger. Okay. So let's say this is your journal. So we have here your date. We have here your transactions. We have here your reference. We also have here your amount for debit and for credit. Okay, so normally journals looks like that. Okay, so normally journals look like that. Now, after we record it in the journal, so we already recorded the transaction that we have analyzed, we will now pause it. So we will pause it. So a ledger normally looks like this. Okay, so we have here minsan ba nga 6 yan eh. So we have here a date, we have here your transaction, and then we have here your debit, your credit, and your balance. Okay, so we call this ledger as 3 money column ledger. 3 money column ledger. Okay, so when we say we transfer the data recorded in the journal to the ledger, we transfer the recorded data by placing the amount or the transaction also to the ledger. So remember, I told you before that ledger is like a summary of the different transactions pertaining to a particular account. So it is a summary of the transactions pertaining to an account. Okay, for example, our first transaction here is we purchase supplies for cash. We purchase supplies for cash. So if ever we purchase supplies for cash, the entry is debit supplies, credit cash. Let's say it is 10,000. And our second entry is we sold or we furnish a service to a customer worth 50,000. So we debit cash, credit service revenue, 50,000. So assuming those are the transactions we have recorded in number 2. Now we go with your third step, that is the posting to the ledger. So when we say posting to the ledger, we transfer the transactions pertaining to a similar account. So assuming this ledger is the ledger of cash, this is the ledger of cash, and it is given a chart account number of 101. So let's say the chart account number is 101. So, sir, what is this cash? This is the account title. This is the account title. So later we will learn what is an account title. 101 is the chart account number. Chart account number. Okay, so we have here different columns. We have date, transaction, debit, credit, and balance. So let's say the date here is 9/1 and this is 9/5. So we have here cash. So when we say ledger, we summarize the transactions pertaining to an account. So what is our account in this example? Our account in this example is cash. Our account in this example is cash. So in cash, we need to transfer everything that is recorded in the journal to the ledger pertaining to cash. So 9/1, is there a transaction pertaining to cash? Yes, the purchase of supplies. So you place your purchase of supplies. And what is the amount of the purchase of supplies? 10,000. Look at the effect on the cash. Did we record the cash in debit or in credit? We record it in credit. So we place here 10,000. Okay. Next, we go now. So this is negative 10,000, the balance. We go now to the next transaction, 9/5. So debit cash, credit service, revenue. So what happened to our cash? There is an increase in cash because we debit it. So how do we place that in our ledger? So to place that in our ledger, we debit also cash amounting to 50,000. So service for cash, 50,000. So balance 10, 50, balance is 40,000. Okay, do not worry guys. This is just an example just to show you how does your posting works. So what we do is we try to transfer the items of cash to the ledger. So this one is already transferred. This one is already transferred. Okay, so the 10,000 cash is transferred to the ledger, and the 50,000 cash was also transferred to the ledger, just to show that the ledger is a summary of the transactions pertaining to a particular account. So here, our particular account is cash. It is summarized in the ledger. Now, guys, maybe you are asking, sir, what is the ref under my journal? So here is the journal book, right? Journal book. This is the ledger. So this is the journal book. This is the ledger. Now, in our journal book, as you can see, there is a column called the ref. So this ref is known as your posting reference. Posting reference. Sir, what do we place in the posting reference? In the posting reference, you place the account number of the chart of account pertaining to the account title. Okay, so in the posting reference, you place the account number of the chart of account pertaining to the account title. If the transaction is already posted. That's why it's called posting reference. So you will only place an item here in the ref or reference in case it is already posted. Sir, what do we mean it is already posted? Meaning from journal, it is already transferred to the ledger. From journal, it is already transferred to the ledger. So in our example, cash, did we already post it? Yes. So we can already place the posting reference. What is our posting reference? The chart account number. So our chart account number is 101, so we place here 101. How about our second one, cash? Was it already posted? Yes. Therefore, we can already place the chart account number 101. Okay, so that's how posting reference works, and how does your chart of account number works together with your journal book, and how do we post items from the journal book to the ledger. Do not worry, guys, this is just an example. I will guide you through it when we go to the process of recording, in which we will really utilize a real journal book and at the same time a real ledger book. Okay, so that is a ledger. Now, ledger is also defined as the books of final entry. It is the books of final entry. So when we say books of final entry, it is the last book that you will utilize in recording the transaction. So final entry, because from journals, we now summarize it through the ledger. Okay. If the journal is the original entry, it is finalized or summarized in the ledger. Okay. Now, I told you, ledger, it shows you the summary of an account. So summary of an account. Now we try to define what is an account. An account is a storage of unit in a double entry system. Okay, so we try to make use of a particular account in which we store the transactions particularly on that account. So for example, here, cash, that is our account. We store every cash transaction to the account of cash. Clear? For example, you are into the service industry. So you are engaged in the service industry. You want to store your account regarding your revenues on a you want to store the transactions on the revenues on a particular account. So let's say that particular account is service revenue. Okay, so you try to store the transactions or event pertaining to a particular transaction into an account. So account is the storage unit in a double entry system. So what is a double entry system? In a double entry system, we say that there must be at least two entries or two accounts affected in a transaction. So as you can see in our examples in the journal, we have at least two accounts. So if there is an item given, there must be an item received. So it has a double effect. It has a double effect. So for example, in 9-1 double entry system, supplies cash. What did we give up? We gave up cash. What did we receive? Supplies. Okay, so a transaction is twofold in its function, in which you may give up and at the same time you may receive. Okay, so account is storage unit, double entry system. So I hope you have at least an idea on what is an account and what is a double entry system. Now we go to your types of accounts. So what are the accounts that we can use in a ledger? So what are the types of accounts that we may use in a ledger and in the journal? So we have two types of accounts that can either be a real account or a nominal account. Real account or a nominal account. So real account are the items presented in the statement of financial position. And what are the items that can be seen in your statement of financial position? You have your assets, we said before, assets, liabilities, and equity. Okay, Why is it called a real account? It refers to permanency. It refers to permanency. Why? Because these items will always remain in our financial statement. It is carried over from period to period. It is carried over from period to period. So permanency, carried over from period to period. How about nominal account? What do we mean by nominal account? So these nominal accounts are presented in the statement of comprehensive income, particularly your income and expenses. Particularly your income and your expenses. So balances over nominal accounts are cumulative only over a period of time. So unlike in a real account, it is cumulative and permanent, while here it is only cumulative over a period of time. So when we say over a period of time, it means that the total amount of income and expenses pertains only on a particular period. Total pertains only to a particular period. So for example, from January to December, let's say, okay? But it can never be carried over. It cannot be carried over. So types of accounts, so that can either be a real account or a nominal account. Real account or a nominal account. Now we go to the types of ledgers. So there can be two types of ledgers as there can be two types of journals. So two types of journals, general and subsidiary. Types of ledgers. So what are the types of ledgers? General and special para dun sa journal. In your ledger, it is your general ledger and subsidiary ledger. General ledger and subsidiary ledger. So what is the difference between a general ledger and a subsidiary ledger? So general ledger contains all accounts. This represents all accounts. So meaning whether that is a real account or a nominal account. How about a subsidiary ledger? It is a supporting ledger to the general ledger of an account. Okay? It is a supporting ledger to the general ledger of an account. So, for example, we have here the ledger of accounts receivable. Accounts receivable. Okay? So, this is the ledger of our accounts receivable. We have a subsidiary ledger. So meaning we have a supporting ledger. Let's say this is one ledger, this is another ledger. So in the accounts receivable, let's say the total is 50,000. The total is 50,000. That 50,000, let's say, is made up of these two subsidiary ledger. So we have two main customers, customer A and customer B. And the balance of customer A is 40,000 and 10,000. So let's say, so again, the accounts receivable of 50,000, that is the general ledger. Now, the accounts receivable of customer A and customer B is the subsidiary ledger, which now supports why does we have or why do we have 50,000 amount as to our accounts receivable. So again, the subsidiary ledger will support the general ledger of an account. If our general ledger on an account is 50,000 as to accounts receivable, then saan ba nanggaling yung 50,000 na yan? So makikita natin sa subsidiary ledger na galing pala yan kay customer A at saka kay customer B. Okay? So again, in our process of posting from your analyzed transactions, we now try to record it in the journal. And from the journal, we post it to the ledger. Now, in the ledger, it is a summary of the transactions pertaining to an account. What is an account? That can either be a real account or a nominal account, but an account is a storage unit in a double entry system. Now, after knowing what is an account, we also learned the types of ledgers. So we can have general ledger or subsidiary ledger, but always general ledger in which all accounts are presented. So different accounts, it must have a ledger. And a subsidiary ledger may be used on an account, if ever, that can support the general ledger of a particular account. Okay, so again, the process from business transaction, we identify and analyze, and then we journalize it, and then we pause it. So we're done with the first three steps. We're done with the first three steps. We go now to step number 4. Step number 4 is the preparation of unadjusted trial balance. Preparation of unadjusted trial balance. So again, in our posting, what is the end or what is the product of posting process? The product of the posting process is that we have now a summary of the balances in each account. So sir, why can we say that there is already a summary of the balances in each account? Remember, in the ledger, what we do is we try to summarize or pause everything pertaining to an account. And then at the end, we get the balance. Diba? Kasi andito yung debit, credit, tapos balance. Tapos magpapakita na lang agad yung balance at the end. So here, in our posting, what then is the end product? We have the summary of balances in each account. Now, in the preparation of unadjusted trial balance, we list now list of all accounts and their balances. So after we get the summary of the balances in each account, we list now each account. So each account. So let's say these are the accounts. And then these are their balances. So debit, credit. Okay. So that is an unadjusted trial balance. So normally, how do we prepare an unadjusted trial balance? So we prepare first by having a heading. So the heading is the name of the company, name of the company or the business. And then we have the particular report that we are preparing. We call it your unadjusted trial balance. And then we have your period. You have your period. And then now you list debit, credit, what are the different accounts and their balances. And then you total it. So at the end of this particular step, your total debit must equal to your total credit. So at the end of this step, your total debit must equal your total credit. Now, why so? Because we say that your unadjusted trial balance, will prove the mathematical accuracy of the items in the ledger. Because if this is not equal, it means that it is not balanced. There may be an error. There may be an error in journalizing and or in posting. Okay? So it is, if it's not balanced, there may be an error in journalizing and or in posting. And since we see it shows the mathematical accuracy of the balances in our ledger or in our journal, then what does your unadjusted trial balance reveal. So what errors are revealed by the unadjusted trial balance? So it reveals two errors. We call them your transposition and transplacement. So when we see transposition, we have an error on the position of the digits in a transaction. So for example, instead of 1, 2, 3, 4, 5, you record 1, 2, 4, 3, 5. Okay? So instead of 1, 2, 3, 4, 5, you record 1, 2, 4, 3, 5. So ano yung nagkapalit na position dyan? Yung 3, 4. Ayan. So there was a transposition. There was a transposition. So there was an error on the position of the digits in a transaction. So in our transaction, it should have been only 1, 2, 3, 4, 5, but you have recorded 1, 2, 4, 3, 5. Transposition. Next, transplacement. In a transplacement, there is an error on the placement of the decimal point. Okay, so there is an error on the placement of the decimal point. So for example, it should have been 500.00. You only record 50.00. So there was an error on the placement. It should be after another zero, but you place it after 1 0 only. So instead of 500, you recorded 50. We call that one transplacement. There is an error on the decimal point. So long as the decimal point was moved either to the left or to the right of the number. Okay, so we call that transplacement. Again, your unadjusted trial balance proves the mathematical accuracy over your total debits and your credits. When we say total, the mathematical accuracy, it means that your debit and credit must be equal. What if your debit and credit is not equal? It means that there is an error in the journalizing and or posting. But what particular error can we deduce from the trial balance? The trial balance will only show you your transposition and transplacement error. Transposition, the error in the position of the digits. Transplacement is the error on the placement of the decimal point. So after knowing what errors are revealed by the unadjusted trial balance, the next question is, what errors are not revealed by the unadjusted trial balance? By the unadjusted trial balance. So the errors that are not revealed by the unadjusted trial balance are the following. First, we have your wrong classification. So when we say wrong classification, you mistakenly classified it to other account. Mistakenly classified it to other account. So for example, you should have classified it under cash, but you classified it under accounts receivable. So you wrongly classified the account. Next, we go with your omissions. When we say omissions, the transaction or event is not recorded or it is omitted in the records. Omitted in the records. So here, there was no entry made. There was no entry made. Since there was no entry made, of course, since mathematical accuracy was only proven, meaning whether it is equal or not, then omission cannot prove whether it is equal or not because it is really omitted. It was not entered at all. The last event or error that is not revealed by the unadjusted trial balance is the double posting. So what is double posting? A transaction or event is recorded twice. Therefore, if the record is correctly made, the error on double posting cannot be identified. Okay, so the error in double posting cannot be identified in case there is a double posting. Okay, so what errors can be revealed? Transposition, transplacement. What errors cannot be revealed? Wrong classification, omissions, and double posting. Okay, so that is for our preparation of unadjusted trial balance, in which we try now to list all the accounts and we test the mathematical accuracy of our debit and credit. So let's have a recap. So what do we do on our first step from a business transaction or event? We check and analyze or identify whether it is an accountable event. First step. If it is an accountable event, if your answer is yes, then you will now try to record it in the journal. Second step. Now, after recording to the journal, assuming it is the end of the period, you will now transfer it to the ledger. So what is the end product of the ledger? We have now the summary of accounts and their balances. Okay. And from the ledger, we will now have your unadjusted trial balance, which now shows the mathematical accuracy over the transactions in an account. Okay, so this is the fourth step. We go now to the fifth step. So what is the fifth step? The fifth step is the preparation of adjusting entries. Preparation of adjusting entries. So what is an adjusting entry? The adjusting entry is used to split the mixed account. So what do we mean by mixed account? When we say mixed account, it is composed, or the balance in an account is composed of real and nominal. Real and nominal. So we have two types of our what do you call this one? Adjusting entries. So we have two types of adjusting entry. The first one is deferral. The second one is accrual. So under deferral, we have deferral of an expense, and we also have your deferral of an income. The deferral of an expense is known as your prepayment. The deferral of an income is known as your pre-collection. And also, we have your accrual of an expense and accrual of an income. So the accrual of an expense is known as your accrued expense. The accrual of an income is known as your accrued income. Okay, so the deferral of an expense is known as prepayment. The deferral of an income is known as pre-collection. The accrual of an expense is known as accrued expense. The accrual of your income is an accrued income. Okay, so when we say the balance in an account is composed of real and nominal account, it means that it is a mixed account. And what are those mixed accounts? We call them deferral and accrual. We call them your deferral and accrual, or prepayment and pre-collection. So an example of a prepayment, let's say we have here a rent. So when we say prepayment, So, for example, you are to enter into a 1-year rent. 1-year rent. So you are to rent a particular space in Baguio City, and that is for 1 year. Now, when we say prepayment, the whole 1 year is already paid. Whole 1 year is already paid. So it means that you have prepaid the whole 1 year. So if assuming today is January 1 until December 31, that is the contract of your rent, you have prepaid from January 1 until December 31. So why do we say it is a mixed account? So for example, today is January 31. Today is January 31. So you entered a contract of 1 year rent for January 1 until December 31. So today is January 31, right? So as of January 31, you have used some of the rent and you have unused some of the rent. Meaning, some of the rent is already expired and some of the rent is unexpired. In short, from January 1 to December 31, 1 month, that is January 1 to January 31, is already expired since you already used it. While February 1 until December 31 is unused or unexpired. So we have used, which is expired, unused, which is unexpired. So the expired here is the nominal account. Why is it nominal account? It will now be treated as an expense. The unexpired here is treated as a real account. It is an asset. Okay, so again, we go back to the concept of adjusting entry. In the preparation of your adjusting entries, we try to split the mixed account. So when we say split the mixed account, the balance in an account will be split into real and nominal. So what are your mixed accounts? These are your deferrals and your accruals. When we say deferrals, that can be deferred expense or deferred income, accrual, accrual expense or accrual income. So a deferred expense is known as prepayment. A deferred income is known as pre-collection. And an accrued expense is known as accrued expense. And accrual income is known as accrued income. So let's have an example on your prepayment. So our example is a rent. So you entered into a rent for 1 year of an space in Baguio City. So you entered there in Baguio City for a space and you will use it for your business as a rent. So instead of paying monthly rent, you paid a 1 year rent. You paid a 1 year rent that is from January 1 until December 1. Now, today is January 31. We said that a portion of that rent was already used or expired, while a portion is unused or unexpired. Why? Because January 1 until January 31, 1 month of that rent is already used, right? Therefore, that expired portion is the nominal, and the unexpired portion is the real. Why? Because the nominal there or the expired portion is known as the expense, while the unexpired portion is the asset. So from 1 year rent, what did we do? This is the mixed account. This is the mixed account. We separate it into your expense and your asset. Expense is the nominal. Asset is the real. Okay, so that is a deferral of an expense repayment. Next, how about a deferral of an income pre-collection? Pre-collection. So when we say pre-collection, this is a collection in advance. Collection in advance. So assuming you have a rental business. Assuming you have a rental business. So particularly, you rent items. You rent items. So in your rental business, you have different portions of property which can be rented out to others. You have the portion of property that can be rented out to others, and in renting them to others, you require a pre-collection. So let's say a customer paid a 1 year rent. a customer paid a 1-year rent. That is from January 1 to December 31. So I have here 1-year rent income. 1-year rent income. Okay. However, guys, let's say today is only September. Today is only September. So we have here a portion that is already used and unused. We have a portion that is already used or unused for the 1-year rent income. So when we say used, it is already earned. If unused, it is unearned. So why do we say that the used portion is earned? Because again, in a rental business, per month, we say we have an income. Per month, we have an income. So today is already September. What is the rent loss? January 1 until December 31. So if ever we try to separate the mixed account as to the rent income, so January 1 to December 31, yan, di ba? January 1 to December 31, we now split it into earned and unearned. We now split it as to earned or unearned. So how much is the earned? How much is the earned? That is from January 1 to September. How about the unused? That is the October to December. Okay, so it means, guys, that here in a pre-collection, although you have collected it, it is a mixed account. Why it is a mixed account? Because it is composed of a real and a nominal account. So what is the real and the nominal account here? The earned is the nominal. We call this one your revenue or rent income. The unused here is the real account. We call this one as your liability. Okay. Anyway, I just want to show you that the adjusting entries really is a mixed account in which we try to separate only the amounts as to expense or asset or income or liability. Okay. So we split nominal and real accounts. And how does your adjusting entries work in the accounting cycle? So we already have your unadjusted trial balance. From your unadjusted trial balance, we will make, so unadjusted trial balance. Assuming in our unadjusted trial balance, there is an account known as your mixed account. So what should we do in your mixed account? We will make an adjusting entry. And in your adjusting entry, there must be a real account and a nominal account. Therefore, take note, in making adjusting entries, you must have one real and one nominal. In making adjusting entries, you must make one real and one nominal entry. So there must be a real account and a nominal account into your entry. Okay, so again, from an adjusted trial balance, let's say the unadjusted trial balance contains a mixed account. We adjust it by making an adjusting entry which contains a real account and a nominal account. So after our sixth step, which is the preparation, fifth step, which is the preparation of adjusting entries, we can now go forward to our sixth step, that is the preparation of adjusted trial balance. So under your preparation of adjusted trial balance, what we do here is from your unadjusted trial balance, from the unadjusted trial balance, which contains the mixed accounts, we will have your adjusting entries. So remember in your adjusted trial balance, you already have a balances of each account. So each account has its own balance. But because of the fifth step, which is the adjusting entry, So from the balance, so let's say this is the balance based on number 4. We have an adjusting entry based on number 5. Therefore, there will be another balance. We call this one as your adjusted balance. Okay. So, sir, are all accounts with adjusted balance? No, only the mixed accounts, and we need to recognize, of course, the accruals. Only the mixed accounts, and also we need to recognize the accrual. Not everything in the unadjusted trial balance has an adjustment. Only those with adjusting entry, and those are accruals and deferrals. Okay. So after getting the adjusted balance, we prepare now your adjusted trial balance. Therefore, what is the adjusted trial balance? It is a trial balance. It is a trial balance which shows the adjusted balance of each account after effecting adjusting journal entries. Okay, so from our unadjusted trial balance, which has balances of each account, we prepare an adjusting entry. That adjusting entry affects any balance of an account pertaining to a mixed account that can be deferral or accrual, therefore, or thereby giving us the adjusted balance. So the adjusted trial balance now gives you the trial balance of the adjusted balance of each account. So how do we prepare this adjusted trial balance? So again, the name of the company, and then after the name of the company, we have the name of the report, which is the adjusted trial balance. Adjusted trial balance. And then after the adjusted trial balance, you place the date. So again, debit, credit. We have now your accounts, and then the amounts. These amounts are the adjusted amounts. These amounts are the adjusted amounts. Okay, so adjusted trial balance. From your unadjusted, we make adjusting entry. We effect the adjusting entry to the account balances under your unadjusted trial balance to get for the adjusted balance. And that adjusted balance will be placed now under your adjusted trial balance, including the other items. But take note, not all accounts will be adjusted. Only deferrals and accrual accounts. Only deferral and accrual accounts. That is the adjusted trial balance. We go now to the next step, number 7. The 7th step is the preparation of financial statements. The preparation of financial statements. So what do we do in your preparation of financial statements? So from your adjusted trial balance, which contains now the different balances on your account, we present them now in your financial statements. And under your financial statements, again, we have how many items of financial statements? We have 5 financial statements. So first, we have your statement of financial position, which summarizes the assets, liabilities, and equity. We also have your statement of comprehensive income, which summarizes the income and expenses, including the items of OCI. And then we also have your statement of changes in equity, which shows the changes over the equity. You also have your statement of cash flows, which shows the changes into your balances of cash through the 3 different activities. You have your investing, operating, and financing. And then last one, we have your notes to financial statements. Therefore, the balances here are presented depending on the type of account. If that is an asset, liability, or equity, then place it in your statement of financial position. If that is an income or expense, place them in your statement of comprehensive income. If that is a change in equity, we place it in your statement of changes in equity. If that is a statement of cash flows, you place it in your cash flows. Or changes in cash flows, you place them in statement of cash flows, and you have your notes to FS. Generally, in basic accounting or in AE 100, we will learn only these three statements. So we focus ourselves on the three statements: statement of financial position, statement of comprehensive income, and statement of changes in equity. So we need to learn the relationship of the three items. So from your adjusted trial balance, remember it contains asset, liability, equity, income, and expense. Okay, so how do we prepare your three statements and what are the relationship? The first thing that you need to prepare is the statement of comprehensive income to compute for the profit or loss. To compute for the profit or loss. And what are the items of your statement of comprehensive income? We have your income and your expense. Your income and your expense. So under your income and your expense, of course, we compute for any profit or loss. So when can we say there is a profit and when can we say there is a loss? There is a profit if ever the income is greater than your expense. There is a loss if your income is lesser than your expense. Okay, so you first prepare a statement of comprehensive income. The second statement that you need to prepare is the statement of changes in equity. Your statement of changes in equity shows the following. So beginning equity plus or minus any investments or withdrawal plus or minus any income or loss. Okay, so we use profit na lang. Plus or minus any profit or loss. We have your ending equity. Okay. So after getting your ending equity, you can now prepare for your statement of financial position, which shows now your asset, your liabilities, and your equity. So what is the relationship? So from SCI, you need to get for the profit or loss. Now we go to your statement of changes in equity, which shows now your beginning equity, plus or minus any investment or withdrawal, plus or minus any profit or loss. We get the balance. So the profit or loss computed in your statement of comprehensive income will flow to your statement in changes in equity. So plus or minus profit or loss. And then you have your statement of financial position. So guys, after getting your statement of changes in equity, the balance here is known as your ending equity. So what is the effect of this statement of changes in equity as our SFP? So again, SFP is composed of your asset, liability, and your equity. So your ending equity will go to the SFP as the portion of equity. So again, if ever we are to prepare financial statements out of the adjusted trial balance, we now place the items in your first profit or loss for income or expenses. And then those items computed as profit or loss will be forwarded to your statement of changes in equity as an item of profit or loss to get for the ending equity. And then we go now to your statement of financial position, which is composed of your asset, liability, and equity. The ending equity computed in the statement of changes in equity will be placed in equity. So again, in this subject, we will focus ourselves on these three main financial statements: comprehensive income, changes in equity, and statement of financial position. Take note again that the financial statements are the means in which the information or financial information that was accumulated or processed under our accounting is communicated to users for making economic decisions. So again, from the accumulated process in our accounting, we now provide the information to the users. Okay, so diba? If we try to take a look, we first have a business or transaction, and then after a business or transaction, we analyze or identify. We analyze or identify whether the business or transaction is an accountable event. After we identify that it is an accountable event, we will journalize. After we journalize, we post it to the ledger. And then we prepare an adjusted trial balance. We prepare an adjusted trial balance. And after preparing an adjusted trial balance, we can have any adjustments through the adjusting entries. And then we have your adjusted trial balance. And from your adjusted trial balance, we get your financial statements. So again, we have this whole process before we give financial statements. So we undergo processes first in which the financial information will be compiled, and then it is communicated to different users, which now the users will make use to make economic decisions. Okay? So financial statements, preparation of financial statements. We go now to the 8th step. So number 8 step is the closing of books. Closing of books. So under your closing of books, we prepare closing entries. We prepare closing entries. The question is, what accounts are closed? What accounts are closed? The accounts that are closed are your nominal accounts. Why? As we said before, a real account is permanent and it is cumulative. While a nominal account, it is an account that is only for a particular period of time. So after the end of the period, so only a particular period of time, therefore, at the end of the period, it must be removed. So how do we remove these nominal accounts? It is removed by preparation of closing entries. It is removed by preparation of closing entries. So we have here nominal accounts. There is a balance at the end of the period. We prepare closing entries. Okay, so closing of books, we prepare closing entries. And what accounts are closed? Only the nominal accounts, because again, they represent transactions during a period. And they are not accumulated, and it is not permanent in nature. Therefore, at the end of the period, it must be removed. It must be removed through the preparation of closing entries. Number 9, the 9th step, that is the preparation of post-closing trial balance. Preparation of post-closing trial balance. Okay, so we have now your adjusted trial balance. We have now your adjusted trial balance, which shows your adjusted balances of accounts. And then we prepare another entry. We have your closing entry. Then, of course, from your adjusted balance, we make any closing entry. This will now be 0. So what is the effect of the closing entry? Since you are closing it, the nominal accounts will be brought to 0. It will be brought to 0. So since nominal accounts are brought to 0 through the closing entry, in our post-closing trial balance, what is left is the real account. What is left is the real account. Why? Because due to the closing entry, no more temporary or nominal account. No more temporary or nominal account. What is left or remaining is the real account. Okay? So let's try to visualize this different trial balance. We have your journal entries. Journal entries. After your journal entries, what do we prepare? An adjusted trial balance. If we will make adjusting entries, what do we prepare? Adjusted trial balance. If we will make closing entries, what do we prepare? Post-closing trial balance. So as you can see, every after an entry, a new trial balance. Okay, so you prepare journal entries. What do you prepare? An adjusted trial balance. You prepare adjusting entries. What do you prepare thereafter? Adjusting trial balance or adjusted trial balance. If you have closing entries, what do you prepare after? Post-closing trial balance. In an adjusted trial balance, what are the items presented? Both real and nominal. For your adjusted trial balance, what do you present? The adjusted real and nominal. Under your post-closing trial balance, what do you present? Only the adjusted real. Only the adjusted real. So there is no more nominal account in your post-closing trial balance. Why again? Because through your closing entries, the nominal accounts were already zeroed out. Zeroed out. Okay? So the post-closing trial balance is the last step in the accounting cycle. The post-closing trial balance is the last step in the accounting cycle. Okay. However, we have this another step, but this particular step is not really mandatory into your accounting cycle. So it depends whether the entity adopts it or not. It depends whether the entity adopts it or not. So this 10th step, again, is not mandatory in your accounting cycle. So it depends on the entity. So what is the 10th step? Preparation of reversing entry. Another entry, sir. Okay. So before, we learned already 3 entries: journal, adjusting, and closing entries. Now, number 10, we have your reversing entry. So what are reversing entries? Reversing entries are entries made on the first day, of the accounting period to reverse certain adjusting entries. To reverse certain adjusting entries. Okay, so reversing entry, what do we do? On the first day of the accounting period, what is an accounting period again? It depends if it's annual or an interim period. But normally, when we talk about accounting period, it is an annual period. And then it is made on the first day of the accounting period to reverse certain adjusting entries. So what are the certain adjusting entries? The certain adjusting entries are your prepayments, recorded under expense method. Okay, so I will just tell you what are these adjusting entries, but soon you will learn what is under expense method. Okay, so we will learn that as we go through our subject. Another is your unearned income or pre-collections recorded using income method. Okay, so again, preparation of reversing entry is not mandatory. It depends on the entity whether the entity will make a reversing entry or not. And what are the entries made into your reversing entry? Only to reverse prepayments recorded under expense method and pre-collections recorded using income method. Okay, what else? We have your accruals, whether income or expense. Okay, accruals, whether income or expense, not mandatory. Not mandatory. Sir, question. A while back, every time we have an entry, we will make a new trial balance. In making your reversing entry, do we make a new trial balance? No, no. Why? Because reversing entry is not really a part of our accounting cycle, and the accounting cycle ends at the post-closing trial balance. The reversing on entry will only be used to facilitate easier transaction, especially for the next period. Why? Because these accruals, this income, and this expense will all be used up next year. Will all be used up next year, or it will be collected or received. So these prepayments or pre-collections will be used for the next accounting period. Next accounting period. That's why they want to reverse it already, even on the first day, and accruals are to be received or paid during the next accounting period. Therefore, to facilitate easier recording, they will rather reverse it at the first day. Okay? So that's it for our accounting cycle. That's it for our accounting cycle. Now we proceed to the second part of our topic for today, that is the analyzing of business transactions. So under analyzing of business transaction, we said from a transaction or event, we determine if that is an accountable event. We say it's an accountable event if ever it affects the asset, liabilities, and equity. So what are these assets, liabilities, and equity? Actually, we call these assets, liabilities, or equity the elements of financial statement. The elements of financial statement. Sure, why is it called the elements of financial statement? Because these items are the items you find inside the financial statement. These are the items you find inside the financial statement. Sir, there is no income or expense because again, income or expense is part of the equity, as we have discussed before in your relationship of the three financial statements. Okay, so these are the elements of financial statement. Before we proceed further in analyzing a business transaction, we need to know the accounts. We need to know the accounts by virtue of the elements. And of course, what are the rules as to the debit and credit of these accounts. Okay, so again, we have your accounts, which are your different elements. And then we need to learn also the rules as to the debit and credit of these accounts. So first, we go with your elements. So what are the elements of the financial statement? We have 5. We have your asset, we have your liability, we have your equity, we have your income, and we have your expense. Okay, so first we determine what is an asset. An asset is a resource controlled by the entity, resource controlled by the entity, resulting from past events in which future economic benefits will flow to the entity. Okay, so normally we have these different resources that gives us future economic benefits. So what are those future economic benefits? Either by the use of those assets or those resources by the entity in which we earn an income. So that is a possible future economic benefit. Or with that use of resource, we can collect cash flows. We can collect cash flows. That is, again, a future economic benefit. So under your assets, always take note that for an asset to be recognized under our financial statements, it is not necessary that there is a physical form. It is not necessary that there is a physical form. So what do we mean by physical form? You can touch and you can see and you can feel it. So those are assets with physical form. But take note, not all assets has physical form because some assets does not have a physical form, just like an intangible asset. Further, right of ownership over the asset is not needed. Right of ownership over the asset is not needed. Why? Why? Because again, in our definition, it is only controlled. Hindi naman sinabing resource owned by the entity. So long as you control it, then it is an asset. So long as you control it, it is an asset. It is not whether you own it or not. The main issue that you need to test here is whether the resource is controlled by entity. Again, we say asset is a resource controlled by the entity. First that we learn is that physical form is not needed. Physical form is not needed. Next, it does not need any ownership so long as you control it. It is not needed that you have ownership so long as you control it. Okay, so that is an asset. Any resource controlled by the entity. Some examples of assets are cash, receivables, property, plant and equipment, supplies, inventory, etc. So those are different resources. We go now to your liability. What is a liability? This is a present obligation arising from past events. Present obligation arising from past events. So these are debts owed by the business. These are debts owed by the business. So mga utang ni business, yan yung laman ng ating liability. Next, we also have your equity. Equity. So what is an equity? Equity is the residual interest of the owners to the business. Residual interest of the owners to the business. So why do we say it is a residual interest? Because again, remember, I have already presented to you this one. Asset is equal to your equity. Asset is equal to your liabilities plus equity because asset is the equity of your creditors and your owners. So when we see residual interest, you try to compute for equity. Equity, if ever we transform this equation, we need to place liabilities to the other side. So what will happen now is equity is equal to assets less liability. Therefore, asset less liability shows residual value, meaning the remaining amount after satisfying your creditors. The remaining amount after satisfying your creditors. We call that your equity. So it is the residual interest of the owners to the business, of course, after payment to the creditors. After payment to the creditors. Next, we have your income. We have your income. Your income are increases in economic benefits. Increases in economic benefits. So if there is an additional economic benefit to the entity, we call that income. We call that income. So generally, there are different terms used as to your income. We have your profit, which is a measure of performance. We have your profit, which is the measure of performance. Diba sabi natin, that is either income less expense. So profit per se is not income. Profit per se is not income because profit shows now or measure the performance. Kaya nga siya tinawag na statement of financial performance. Another term that is closely related to profit is the revenue. So when we say it is revenue, or another term that is closely related to income is revenue. When we say revenue, it is an income arising from ordinary course of the business. Income arising from the ordinary course of the business. Okay, it is an income arising from the ordinary course of the business. Sir, what do we mean by ordinary course of the business? This is the normal operation in which the business is engaged. It is the normal operation in which the business is engaged. So for example, if you are in the business of buying and selling, your revenue comes from selling. Okay, so if ever you have the normal operation of buy and selling, therefore your revenue comes from selling. So what if I have a revenue not from selling? What if I have a revenue not from selling? We call that gains. So another term closely related to income is gains. Why? Because gains are other items that is not a revenue. Other items that is not revenue. Therefore, these are still increases of economic benefits, However, it is not from ordinary course of the business. Okay, so again, we have your gains. These are other items that is not revenue, because we see revenue comes from your ordinary course of the business. So if your business is engaged in buy and sell, this the main or ordinary course is of course from selling. However, let's say you have interest. Did you sell anything? No. Let's say you have an interest income. Did you sell anything? No. Okay. Therefore, that is a gain. Take note, when you sell anything, we say we sell the ordinary course of your business. So for example, you are into the selling of books. So if ever you sell books, we call them revenue. Sir, what if I sell my property? Is it called revenue? No, we call it gains. Why is it gains? Because again, the ordinary course of your business is only to sell books, not to sell properties, or not to sell a land, not to sell an equipment. Therefore, any other items not under ordinary course is called gains. How about an expense? An expense is a decrease in economic benefits. So it's easier to understand what is an expense and what is an income. So income is an earning, and expense is any incurrence or any expense per se. Because there is no change as to the definition of an expense into your accounting. As long as there is a decrease of your economic benefits or a decrease of your assets, or there is a decrease of your, there is an increase on your liability, we call that an expense. Okay? So what are the elements of the financial statements? We have 5: asset, liability, equity, income, and expenses. Now, after knowing the different elements, we go first to the rule of debit and credit, and we see the effect of this debit and credit into your different accounts. So we go now to the rule of debit and credit. So we will now formally starting what is debit and what is credit. So what is the rule of your debit and credit? Always take note that debit is the left side. It is known, or it is shown as DR. And credit is the right side. So it is known as your CR. Guys, if ever you see this letter, or have you ever seen this type of image or a type of a shape, we call this your T account. We call this your T account. Why? Because it looks like a letter T. So under your T account, at the top of it, we normally place the account title. What is the account title again? That is the account. And then on the left side, we say this is your debit. On the right side, we say it is credit. Okay? On the left side, it is debit. On the right side, it is credit. Always remember that debit and credit is left side and right side. Always remember that debit and credit is left side and right side. Next, we need to learn is debit and credit can either be increase or decrease in an account. Debit and credit can either be an increase or decrease on an account. Debit, left side. Credit, right side. Clear? Okay. Now we go to your debit and credit can either be an increase or decrease. So what is our accounting equation? We have your asset is equal to your equity. We expand it further. We have now asset is equal to your liabilities plus owner's equity. We expand it further. Asset is equal to your liabilities. What are the items of your owner's equity again? Diba? Owner's equity, we have your beginning equity plus any investment less any withdrawal plus any income less any expense, right? Okay. So if we try to expand that, what are the items that affects the owner's equity, investment, withdrawal, income, and expense? So we try to expand owner's equity in this formula. Therefore, we add any investment, we deduct any withdrawal, we add any income, we deduct any expense. Okay, so our main equation, we expand it. Asset is equal to your liabilities plus owner's equity. We expand it further. We have your asset is equal to your liabilities plus investment less withdrawal plus income less expense. So where did we get investment, withdrawal plus income less expense? It came from the computation of your changes in equity. Remember, in changes in equity, what are the items that we look for changes? Plus or minus investment or withdrawal, plus or minus any income or expense. Therefore, we place it here, plus investment, less withdrawal, plus income or expense. So as you can see, our final formula is asset is equal to your liability, plus any investment, less any withdrawal, plus any income, less any expense. Okay, question. Are the items in positive balances? Are the items in positive balances? The answer is no. The answer is no. Why? No. Why? Because you see, we have here negative withdrawal and negative expenses. So take note, we must all place it as positive. So what do you do, or what will you do so that we have positive balances? So to make withdrawal positive and to make expense positive, we need to transfer it on the other side, right? We need to transfer it on the other side. So the other side now is asset. We transfer withdrawal. We transfer expense on the other side. So plus withdrawal plus expense equals liability plus investment plus income. Question. Are the items now all in positive balances? Yes, because everything now is in positive form. Everything now is in positive form. Since everything now is in positive form, the positive balance, take note, the positive balance is the normal balance. The positive balance is the normal balance. So when we say normal balance, it should be at its positive form. So pagka normal balance pala yan, it is positive. So meaning, add or increase. Pagka other side, it is negative, meaning deduct or decrease. Now, pagsamahin natin yung natutunan natin kanina na ang debit ay left side, ang credit ay right side. Okay. So what are the items on the left side of the equation? This is our equation, right? This is our equation. Asset plus withdrawals plus expense is equal to your liabilities plus investment plus income. What are the items on the left side? The items on the left side is asset, withdrawal, and expense. What are the items on the right side? We have your liabilities, investment, and your income. Liabilities, investment, and your income. Okay, so what is the use now of this debit or credit? Sabi natin, if it is under its positive, that is the normal balance. And the normal balance is add or increase. Other side is decrease. Okay, so what is the positive balance here on the left side? So our normal balance then, here on the left side is debit. Kasi nga, debit is left side. What is the normal balance on the right side? Credit. So normal balance nito is credit. Okay. What is the use of the normal balance? Normal balance is add. So kung meron tayo nitong T account, that can either be a liability, an investment, or an income. That can either be a liability, an investment, or an income. What is the normal balance? Credit, di ba? Normal balance is credit. So the other side will be debit. The other side will be debit. So anong sabi natin? Pagka normal balance, you add or increase. Other side, deduct or decrease. So in short, if the account is a liability, an investment, or an income, if you increase it, what will you do? You credit it. Okay. So if you will increase liability, investment, or income, what will we do? What do? You credit it. If you will decrease, you use the other side, which is debit. Okay. So again, the positive balance is the normal balance. So we started from your accounting equation. So from your accounting equation, there are negative balances, right? So what did we do? We transpose the items to make each of the equation or part of the equation positive. Now the positive balance now is called the normal balance. Now take note, under accounting, the normal balance is add or increase. The normal balance is add or increase. The other side of the normal balance is deduct or decrease. Now, from your accounting equation, you look for the items under the left side and under the right side. So here, asset, withdrawal, and expense is on the left. Liability, investment, and income is on the right. So since asset, withdrawal, and expense is on the left, ano uli yung left side natin sa debit or credit? It is known as debit. The left side under your debit and credit is known as debit. What is the right side on your debit or credit? It is known as credit. So the right side is known as credit. So after knowing that, debit is left side. What are the items of left side? Asset, withdrawal, expense. Credit is right side. What are the items of the credit? Liability, investment, and income. Next na kailangan nating alamin. We determine the normal balance based on where it is. Based on where it is. Okay. So, nasan si liability, investment, and income? Right. Right, di ba? So, kung nasan siya, yun yung normal balance niya. So, ang normal balance din ng ating liability, investment, or income is credit. Credit. Paano naman pagka other side, debit? Pag normal balance, tandaan, you need to add or increase it. Other side, you need to deduct or decrease it. So, ang normal balance, liability, investment, or income is credit. So, pag mag-a-add ka ng liability, mag-a-add ka ng investment, mag-a-add ka ng income, credit. Pag magbabawas ka ng liability, magbabawas ka ng investment, magbabawas ka ng income, debit. We go now to your asset withdrawal or expense. Okay. So for your asset withdrawal or expense, what is the normal balance? The normal balance is the positive balance. Nasaan siya positive? Nasa left. So since it is on the left, the normal balance is debit. If that is the normal balance, anong effect niyan? Add or increase. So if you want to add asset, withdrawal, or expense, you debit it. But if ever the other side is credit. What is the effect on the other side? Deduct or decrease. So if you want to deduct asset, withdrawal, or expense, you credit it. Okay, so again, what do we need to learn here? From your different elements, which is composed of your different accounts, you learn when to debit or when to credit. You learn when to debit or when to credit. Okay, debit is left side, credit is right side. Debit is left side, credit is right side. So you check at the normal balance. The normal balance is where the items or elements are at their positive form. The other side of the normal balance is where they are at negative form. So liability, investment, income, they are at positive form in the right. And the right is credit. The right is credit. Therefore, you increase it through credit, you decrease it through debit. Asset withdrawal or expense is on the left. So the positive, therefore, is on the left. And what is left side? Debit. So you increase it through debit, you decrease it through credit. Okay? So that is the rule of debit and credit concerning your different elements. That is the rule of debit and credit concerning your different elements.